Chapter 13, yeah, week 11. So, investing fundamentals. Um, this chapter, we'll get into more details on future chapters in terms of stocks and some of the other specifics or more in detail. We'll do kind of a broad brush on this chapter. For those of you who've read it, they basically just go over exactly what they say there, just the fundamentals, just the investing fundamentals. So they don't really mention too much in the way of strategies, but we'll talk about it as we go. These are the out or objectives. Why you should establish safety, risk, income. Everything's a trade-off. You know, safety is not necessarily always safe, and risk is, um, too much risk is a bad thing, but not enough risk, and you'll get eaten alive by inflation, taxes, everything else. And liquidity, growth, all of that. So we'll highlight every one of those topics as we step through it. Why you should establish an investment program. Okay. Um, you need to have some goals in terms of what you're looking to provide through your investments. Most times people are focused, at least long-term investing, or on looking at a retirement. Kids college, saving for a house, but ideally a house can be part of your investment portfolio. So, and then how much risk are you willing to assume? That's real important. The time to find out that you don't have an appetite for risk is when the market tanks and you panic and you sell and then you get really clobbered. Most of the time, if you're dealing with real speculative things or you know options and futures and stuff like that, yeah, you can get burned quite badly. But if you're dealing with fairly established companies, um, and especially if you're diversified, you can generally ride things out and do better. But if you panic, um, all is lost. You may not be able to recover from that. So anyway, you just have to make sure that you know what your risk tolerance is. And again, most people are very risk tolerant when the market's zooming up, but when it tanks, that's when you really find out what your appetite for risk is, and what your tolerance is. Um, Establishing investment goals. So possible economic, personal conditions. Again, if you're going to have an investment program and then something not exactly catastrophic happens, but you end up dipping into that investment program, that's not always ideal. Once you put the money in there, you should have it in there, and remember what your goals are. The sacrifices necessary to meet your investment goals. Again, my situation is probably not ideal, but when I was young, I invested in some pretty speculative things just because investing in bonds and some of these, dividend paying stocks, they're frankly a little bit boring. And I had a bit more fun, watching stocks and looking for things. And I did all right, but the slow and steady progress is probably the best. But if it means you aren't going to put the money aside for it because it just doesn't not interesting to you, and that's probably not the best rationale for investments. You should have a little bit more disciplined strategy. But hey, at that time I was a young fighter pilot, and I was happy to you know be more aggressive. What will the consequences be if you don't reach your investment goals? Well, ultimately this could be quite dismal if you don't have your basic needs met. But that's why usually a diversified strategy, one that has some solid stocks in it or solid investments in it, um, annuities, other things that are um, you know very low risk, and then a certain percentage of higher risk. And then again, in terms of what we'll talk about asset allocation, generally the allocation tends to um, be more conservative as you get older because you have less time to recover if things happen to turn out badly. If you're in your 20s or 30s and the market tanks with all your money, but you don't need that money for 20, 30 years, uh, you really shouldn't panic because um, historically the market's going to bounce back just fine. So it's the short, 10-year periods where you could find yourself in the dumps for a bit and might need to worry. And are your investment goals reasonable? First, have to establish them. Financial checkup. Okay, so we've been talking about these other things in terms of budgeting. Do you spend more than you make? Well, then you're not going to be able to invest. High interest credit card debt. As we said, credit card debt is not tax deductible. So if you're paying, 12% on your credit cards, and you also have an investment program where you're making 8%, well, that's not good. You're automatically starting out in the hole, and guess what? That 8% isn't really going to be 8% because you're going to be taxed on that. And so, you're looking at something like 6% interest, and you're paying twice that for credit cards. So anyway, you got to get credit cards taken care of first. Like I say, credit cards are not a bad thing, but you just need to use them wisely. Use them as maybe as an emergency fund, or a portion of your emergency fund, and you also take advantage of some of the benefits that come along with them, but you try to achieve a zero balance every month so you don't get hit with interest. Emergency fund, 3 to 9 months of living expenses. That'd be nice to have that in some sort of liquid investment. And then, that's what I'm saying with a credit card. We'll say a balance of, not a balance, but a limit of $20,000. Now you've got, some real cushion there if you want to ride things out, or if you are in a situation where you're forced to ride things out. Have access to other sources of cash, line of credit. Again, line of credit and a credit card will work the same. The cash advance on the credit card, I do not see any circumstances where you want to do that unless people are insisting on getting cash. But no, you would be better off purchasing things, necessities on a credit card. You can buy food, gasoline, most of your needs on a credit card. And if you're taking cash advances, now you're going to get clobbered, because if you read your credit card statements carefully, you'll realize that all that business about paying off your credit card each month and not having to pay interest, none of that applies with cash advances. They start charging you interest from day one and will keep charging it. And it's a whole different category if you look on a typical credit card. So even those little checks they give you, yeah, you're better off just tearing those things up. Maybe putting a couple if you've got a safe, somewhere for a real emergency. But I can't think of too many expenses these days where you can't put it on a credit card. And even some folks who won't take credit cards, they will take them, but you'll have to pay 3% more, which is just what they're being charged. So keep that in mind. But yeah, avoid cash advances. 8 steps to managing your financial crisis. Financial. That's hopefully not yours. You don't want to have personalize this. A large and fund emergency fund. Know what you owe. Reduce spending. Pay off credit cards. Apply for a line of credit. What happens is a lot of people are in kind of rocky shape, and then something bad happens, and now they're in a hole, and they've just dug a lot deeper. So you want to make sure that unless it's a rainy day, unless it's raining outside, you should be not necessarily living paycheck to paycheck. You should have the ability for an investment program. And also there's a great, benefit to learning how to live within your means, which includes investments. If you pay yourself first, is what they say. And if you, subtract out your investment money just as if it's a bill before you even start looking at the paycheck, then you're going to be in much better shape. You're going to be able to live within those means. And if things, go horribly wrong, you've already got a cushion in there, because you can suspend your investments for a short time and not do any serious damage. So it's always a good option to be able to live not only within your means but well within your means. How badly do you want to achieve your investment goals? Are you willing to sacrifice? You're going to have to sacrifice. Everything's a bit of a sacrifice. Some are more painful than others. But you get into needs and then you get into wants. You can't sacrifice needs, but you can certainly sacrifice wants. Elective saving program. And again, we've talked about all the deferred options and the different means of doing that if it's going to go into retirement. Now, if it's just going to go into regular liquid type savings, yeah, there's not going to be any tax deference on that, but you can do an allotment type thing. Um, you know, Either your employer will do it or your bank will do it. So I always prefer to do it with my personal bank. That way I have a little bit more control over it and it doesn't get stuck in the whole bureaucracy. But the best way to have this done is, the amount that shows up in your checking account on payday is the amount that you basically have left to spend. So your investments ideally would already be investment money would already be taken out of that, so you wouldn't you know be confused. Factors affecting the choice of investments. So safety and risk. Again, people get too, they think, well, you can't be too safe. Well, in investing, you can. You can be so safe that your interest rate is below what the inflation rate is, and now you're losing. Even if you've got some minimal interest rate, say 2%, and inflation is 2%, you're still losing. You're not even breaking even because you're going to be taxed on that 2%. So, yeah, it's a no-win situation. Inflation is going to eat things up. Now, risk, the reason why something pays 2% and something pays 10% should be, in a perfect world, correlated to the amount of risk exposure. So, investments range from very safe to very risky. Yeah, that goes without saying. Some of the super speculative stuff, there's actually special categories where, according to the IRS, for a salesman even to show it to you, you have to have a net worth of $1 million. So you won't see a lot of the super speculative stuff, but just the same, you can find it. You can find other things that will hurt you. Potential return on any investment should be directly related to the risk. That's what we're saying. Sometimes there's anomalies, but again, in a perfect world, if you're making, let's say 15% interest, there's some reason you're being paid 15% interest, and there must be a fair amount of risk. Or in the stock market, sometimes there are these surges, and sometimes there's, pullback. So again, if you're not there for the time when it's going up 20% a year, it's going to make those times when it drops 20% a year pretty painful. So what you're looking at is the long term. Speculative investments are high risk. Yeah, and they're usually shorter term too. So if you've got some money, if you're looking at, say, getting a boat or something, you can't get there unless you do some sort of high risk. That's one thing. But that's not your retirement. There's different levels of risk that you should endure based upon what the goal is. And that's where you sort of stratify your money. You put it into different categories. So the speculative stuff, your needs need to be taken care of before you jump into the real speculative stuff. Okay, so here's what they're showing, this pyramid, and they're showing that, obviously the low risk versus the high risk. Speculative stocks, options, commodities, other high-risk investments. Yeah, penny stocks, I can tell you for one thing, I have got clobbered on every attempt. It's fun, but believe me, you can lose, well, you'll lose what you put into it. So I don't see too many folks doing that. Options, maybe, but again, that's super speculative stuff. Commodities, interesting to do, but again, probably outside the scope of what you want to do, at least for a few years, or unless you're, again, this is the $500 that you're going to blow on something, maybe that would be the money, but not your, certainly not your retirement. Growth stocks, growth-oriented mutual funds, and rental property. That is where I put most of my stuff. So the safety and income, the level 2, U.S. securities, selected municipal bonds. Sometimes, but you're beating inflation, and then you get into financial security, and you're getting generally less than inflation. So, I think for most of us, that financial security, that's not really the investment part. That's more of your rainy day fund, and what you're looking at is level 2 and level 3. And the younger you are, the more level 3 you should have, because you can ride those slumps out. When they talk about the stock market, as a rule of thumb, going up about 10% a year. Historically, that's true, but there's certain stretches where it goes down. We've all seen those 87, 2008. There's sometimes where it just gets clobbered. And if you're getting in and out at the wrong time, it's buy low, sell high. And some people, unfortunately, they get all excited about the stock market, but what happens is it's way up. It's at a peak. They're looking at these earnings where people have got 20, 30% over the past year, so they jump in, and then all of a sudden there's a market correction where the market dives, and they didn't have this appetite for risk. They jump out and they just sealed their losses and they got killed. So, it's pretty dramatic. Back in 2008 when things all fell apart, people dropped. I mean, I had some things in my portfolio that went down by 40%, but they're all back. In fact, they're up. So, again, I wasn't retiring in that particular time frame, so it didn't really bother me. In fact, if I had extra cash around, which I didn't have too much, but what I did, I bought. I mean, that's the time to jump in. Most people will also talk about a dollar cost averaging theory, and this is a strategy to minimize, this market timing, this getting in and out at the right time, because most people have proven to have no skill at it. And so what they'll do is they'll do, say, a dollar cost averaging, where all you need is, say, $100 a month, and you just put that in every set period, and like I say, it comes out of your paycheck. And when the market's up, the market's down, you aren't really too worried about it, because on the long haul you'll do well. And then when you're retired, you're kind of dollar cost averaging out. You typically would not take it out in a lump sum. You would start to take withdrawals from it. So again, your exposure to market timing. Anyway, that's a skill in its own, and believe me, most people have found that random chance is more successful than people trying to time it, because they usually get it horribly wrong. So risk tolerance, that's the key to the thing. But again, I think, at least from what the book and from most people I've worked with, they don't think they're enduring risk by getting a low yield, and really they are. They're just not even treading water. They're sort of sinking a bit, because inflation's eating them up. And what yield they do get, what return they do get, is taxable. So anyway, calculating the rate of return, initial value, so buy low, sell high, ending value. Divide the estimate and value. Yeah, this is just basic math. But there is the inflation risk. So right now we're not in a period of high inflation, but again, investments aren't paying much. So you see these, the down in the CD kind of rate, those things, the yield will go up at some point, but the inflation will match it. The reason why the yield is what it is because inflation is what it is. So the two, track each other quite well. Anyway, inflation rate risk, you may invest in a bond at 6%, later go up to 8%, your bond price fails. So again, when you lock in a certain investment at a certain time, and this one they're at 6%, and they're locked in for a certain period of time, it went up to 8%. Yeah, that's gonna hurt. Business failure risk. So you get into companies again. They talk about investment strategies, trying to catch a falling knife. Not necessarily something you want to do. When I said that, when the market really dipped, that was an opportunity to buy. That is, but it does involve a bit of market timing, and the problem is trying to find out where the floor is before things start to rebound. So anyway, that's what they mean when they talk about trying to catch a falling knife, because it's very difficult to predict and where it's going to hit rock bottom. But when things have settled out, usually 3 or 4 days into a big drop, that would be the time that I would be buying. Market risk, prices fluctuate because of behavior of investors. That's true. And again, now we have this, everything is amplified because of automatic trading, or even glitches in the system that cause, problems. There's a Twitter's about to go IPO. Well, there's another company that sounds roughly like Twitter, and their stock price just fluctuated because people can't spell, and they invested heavily in it. Anyway, stupid things can happen, especially when computers are involved. They can get magnified. The global investment risk, yeah, currency in different countries, especially in Turkey or well, just Turkey was the country I was in for 3 or 4 years, and you did not hold cash because it just devalued daily. So those sorts of risks can be pretty extreme. So investment income. Okay, this is what they're talking about in terms of things you would count on for going forward. But the safest investments, predictable income. So savings accounts, certificates, deposits, savings bonds, and treasury bills. Again, you're going to be basically locking in a decline. This might be money that you're going to need in the next few years, and you just cannot, handle any decline. So you're trying to minimize the impact of inflation, but you're not going to, um, you know, probably even reach inflation rates with these types of investments, but they're safe. But see, safety is relative. Higher potential income, municipal bonds, corporate bonds, preferred stocks, common stocks, income mutual funds, and real estate rental property. So again, the bonds are the two different types there. Sometimes there'll be tax exempt bonds, but keep in mind that that's usually factored into the rate that's paid, the yield. So preferred stocks and income common stocks. Preferred stocks, for people who don't, know much about stocks, like, oh, I definitely want the preferred ones, but preferred typically refers to the dividend. That if the dividend is not going to be paid to all classes of stock, the preferred stock will reach the dividend. I don't typically invest in stocks that pay a dividend. I usually invest in growth stocks, so it was never of much consequence to me. Income mutual funds. So again, mutual funds are nothing but stocks, but they're just a collection of stocks. So you have some mutual fund companies. You go to their website or whatever, and you look at how their mutual fund manager or team has selected a bunch of individual stocks and how they've chosen to sort of package them. And what they've done there is, by putting together an aggregation of stocks, if one company fails, it's not catastrophic. So it gives you some diversification. There's also a feeling that the mutual fund manager is going to know when to buy and sell, and he's going to take different market positions based upon strategy. The truth is, though, that most people are switching to index funds, which are just more mechanically chosen. They're just a selection that reflects the index, because they found that these guys, again, picking market time and jumping in and out, they often do it wrong, and it's people have been more successful just sticking with the index funds. So it's really kind of an insult to the folks who thought they were pretty skillful in that regard. Real estate rental property. Again, this is going to take more active investment typically on your part, but this could really pay off. Again, in my situation, I was fortunate enough to be overseas. I was in Europe for a number of years, and I bought a house in Germany. And so that property is fantastic in the fact that Germany, there's very tight zoning control, so it's not the greatest place to live in terms of quality of life, and you do kind of have people breathing down your neck all the time. But they don't necessarily produce much in the way of any slums. There's not subdivisions where there's always this kind of urban sprawl and neighborhoods change over time. In Germany, neighborhoods are pretty solid. In addition, the houses are built of stone, literally. So I'm pretty happy with that. Plus, with the Germans being the way they are with the rules, there's very little riffraff that goes on. So to have rental property here in the States, it would have to be, you'd have to judge on a case by case. But some of this slumlord stuff, that doesn't appeal to me at all. It'd be very high maintenance in terms of some of the renters and high maintenance in terms of the property. So it depends on your situation. Some of you have probably done quite well. I've had a few students who actually already own income property and newer places, and they'll probably have them for 20 years and they'll do great. But again, it's a broad category. It's a whole course in itself in terms of talking about real estate rental property. But it does have advantages. Investment growth. Okay, growth type stocks. So we talked about income stocks, and this is a growth stock. This is where most of your value, most of your wealth accumulation and holding these stocks is because the stock price goes up. So you aren't going to find a dividend because the dividends get reinvested. The company's growing. They aren't paying dividends to the shareholders because they're using that money to make the company bigger. So these are usually smaller, more aggressive ones, typically when they're growth. And so again, the income stocks, they're larger, more established companies. Growth is probably fairly stable, and they pay a dividend, and that's how they attract investors. You don't really expect the share price to go up greatly. And again, the mutual fund does not mean anything about the type of stocks that are within it. There can be all kinds of different investments within a particular class. So mutual funds can be very aggressive, they can be growth, they can be income, they can be any combination. In fact, they even have real estate trusts, REITs and stuff. So anyway, we talk more about that. Investment liquidity. Okay, how quickly can you buy and sell something? And as I state, obviously real estate is not very liquid. Stock market, there's a market made. May not always get the price you want, but within the stock market, it can switch around quite quickly. Asset allocation and investment alternatives. So asset allocation, the process of placing your investments among several different types of investments, which lessens your investment risk. Okay, and they mention the time factor and your age. So asset allocation, again, if you've got a lot of time, you probably want to be in equities, which means stocks. You want to be in the growth side, and your portfolio would have a smaller amount of bonds and other things that are less would yield less, and that's because you have a lot of time. Now, if you're getting older and you're getting closer to retirement, to have everything in an aggressive income portfolio or aggressive stock portfolio would be fairly risky because, like we say, the stock market can go up and down in 10-year cycles, and if it happens to be on a downstroke when you need to start withdrawing money, yeah, that's going to be a problem. Or the kid's coming up on college, and the market tumbles just during those 4 years. That would be bad. So, stock with equity financing. Equity capital is provided by stockholders who buy shares of a company, stock owners. So, with stock, you actually own a portion of the corporation. So, the corporation is not required to repay the money obtained from the sale of stock. No legal obligation to pay dividends. So, again, you were part of the company, and if you own stock, you'll often get the proxy sent to you for voting on different issues and what to do with dividends, say. But the chance of you having a meaningful say, there's going to be somebody with a huge chunk of stock who's going to kind of call the shots, and the rest of you are just going to be along for the ride. They mentioned the two basic types of stock, common stock and preferred stock. Again, this is an issue with income producing stocks typically. Growth stocks, they don't pay dividends, so you're not too worried about it. Corporate bonds and government bonds. So it's just a loan. What they'll do is they'll put out a bond. You'll receive those interest payments until it matures, and you can also sell it, though. There's some liquidity to it. You don't have to hold on to it, but they'll issue a bond and they'll pay a yield on it. typically, pretty stable investments. Mutual funds, investors' money is pooled together, invested in a professional fund manager. Some people would argue how professional these guys are when it seems as though the index funds, the ones that are just a selection of a particular stock index, do as well as these guys who tend to juggle things. You buy shares in the fund. Diversification, that is a good benefit, a great benefit of mutual funds. The fact that you aren't just invested in one company. So you may be in a sector, you may be broader, it can be whatever combination. So if you haven't looked, go to a website and look at the different fund spectrums, and they have ones that are kind of tailored to whatever. I mean, you can invest in funds that are agree with your social outlook or whatever. There's green investments. There's investments that don't invest in certain countries. There's ones that are just aggressive and invest in anything or only in oil. Or anyway, it's an interesting mix. If you want to buy stock in foreign companies, it's usually kind of difficult to do, to go to those exchanges, but you can buy mutual funds, domestic U.S. mutual funds that invest in those markets, and so you can be a part of that market without all the chaos that would be involved in trying to invest in a foreign stock exchange. Match your needs, your fund's objectives, and the fees. The fees can vary quite a bit amongst the different companies, but there's a huge number of stock companies out there. A lot of them are kind of household names, Vanguard, Fidelity, yada yada. But there's some good objective guides to that, like say Morningstar or other magazines that will put together evaluations of the different mutual fund companies. What you have to be careful of, though, is there's always that caveat, past yields are not indicative of future returns, or however they want to put it. If the stock went up, mutual fund went up 30% last year, were they lucky, or is it at a absolute peak and it's got nowhere to go but down? It's really difficult. So maybe look at a 5-year average and make sure that they actually have got some skill that's making that work out for them. Asset allocation in terms of real estate. Yeah, 3% is average, but again, you're not, when people say, well, what's the unemployment rate? Well, who cares what the average unemployment rate is? You care about your own personal situation. So, for most of you, when you're college graduates, you can maybe take 2/3 of the unemployment rate, and that's what matters to you. It's probably at least a couple points less. If you get a master's degree, it's probably another point off, and if you go all the way to PhD, you're looking at unemployment down in 2-3% range, which is just transitional. So again, it depends on your situation and where you are. So location is important in real estate, but it's also important on what you expect to do with it. Where you're located. I mean, if you're in some market like, say, Las Vegas, has these huge swings. It's totally different than it would be up here in Alaska. So locally, though, in Alaska, obviously, there's certain areas of town that I would not want to be a real estate investor because, anyway, I just have a preference for the higher scale of housing that you would get renters that would probably be a little bit more financially secure and probably be a little less drama every time it comes around to collecting rents. But that's up to you. I know people who are on all ends of that spectrum. Asset allocation, investment alternatives before you buy real estate. Okay. Again, I've told you, I do have a real estate license, but even before that, this is where the agent, the agents that kill me are the ones that give you opinions on, drapes and other things. I mean, I can paint the house a different color. I can do this, I can do that, but what I can't do are some of these locational type things. I actually live out in Eagle River, and my agent, she paid for herself just by keeping me off of basically the cold side of Eagle River around Highland there. I didn't realize that it was going to be shady and dark and cold a large portion of the year. My apologies if you happen to live there. But anyway, that has a huge difference in the price and the desirability of the real estate. So getting that sort of insight, answering these questions, you need to select an agent carefully and then ask them these questions. So establishing all these facts. The taxes, you can kind of figure that out. But again, taxes in Alaska and all these things in Alaska are very tough to find out because it's a non-disclosure state. So you can look up, you can get the public tax records, but you don't know what the age of the person is or whether they're a disabled veteran. If they're either one of those conditions, their taxes are going to be much less. So you're going to think you're paying low taxes. When you get into the house, you may realize that you as a younger able-bodied person are going to be paying quite a bit more. So anyway, could the property decrease in value? All property could decrease in value. So that's kind of a silly thing. That goes into the risk part of it. Speculative investments. Yeah, I was in a situation where people were buying rugs. We had access to rugs coming out of Iran and Afghanistan. I had other rugs. And I just never saw the value because there was no liquidity to them. Plus, people go to galleries and things like that to buy them. In the secondary market, nobody's going to pay you that kind of money on Craigslist. So unless there's something to establish market for those things, I would stay away from it. These other things, call and put options. Again, you're shorting stocks and you're taking different positions in stocks. Again, more aggressive if you're could be fun, but that's what you're going to do with that after you've got an investment program established and some money to play with. Derivatives, the term explains itself. They derive their value from some baseline investment. So this is what happened with the whole real estate market, where people got so enamored with the rates they were getting, they didn't realize that the underlying value was being derived from nearly worthless real estate investments, ninjas, no income, no job, no assets. And those were the folks who they had these derivatives on. So bad. Commodities, again, more aggressive. You normally buy those through futures contracts, so you can not only lose the money you invested, but considerably more. Coins and stamps, counterfeits and everything else, that's a problem. Precious metals, this would include gold. A lot of people are very, very, whatever. They want to diversify and have some gold or some silver. And gemstones. I've seen a number of fake gemstones from different parts of the world I've been in, so I'd always be leery of that. But the precious metals, I can't argue against it because there are some smart money who do well in that. But again, make sure you're dealing with somebody who's reputable in terms of dealer. Don't be buying chunks of lead, something else. Personal plan. So the realistic goals, the amount of money you need to meet your goals. So again, your goals though should be stratified. You should have your wants and your needs, and don't mix up the two. So your needs are going to have to be, if you're young, they can still be in growth investments, but you aren't going to be super speculative with those types of investments. For your wants, yeah, if you lose that money that you have invested, is it going to, cripple you financially? And if not, yeah, go ahead, especially if you have time to recover. And choose at least 2 different investments. Evaluate your investment program. Yeah. So anyway, people generally within an asset allocation strategy, people will set up a certain amount that they want in perhaps growth stocks, another amount in investments, perhaps real estate as part of that portfolio as well, and then cash. But again, I don't necessarily consider cash an investment. Cash is more of a safety item, unless I'm speculating, unless I think the market's going to drop. But again, that brings into play market timing, which, again, in these markets, it's very tough, and there's other people involved, so it's hard to hard to time that. There's a lot of government interaction. So factors that reduce investment risk. So yeah, monitor the value of investments, keep accurate records. Financial planner. Again, financial planner is different than a salesman. You know, I did buy some stock at one point through one of the big brokerage firms, and later got some information, a couple letters about class action lawsuits that had been filed against that broker, and it was one of the big boys. It was a Merrill Lynch or somebody like that, and yeah, they had they had a stake in that company that they hadn't represented. So I don't trust those folks anymore. But financial planners, somebody who's independent, who's not on commission, they can do quite well for you. Consider the tax consequences of selling your investments. So again, this gets back to what we talked about before about doing your taxes before the end of the year. There may be a situation where you're expecting to potentially lose your job next year, or perhaps get a huge boost in income. It may affect when you want to buy or sell. So, well, typically selling. So if you're expecting a huge boost in income the following year, you may want to sell before the end of this year so that you're taxed at a lower rate. Use the various sources of financial data. Yeah, Yahoo and Fool. I do like Motley Fool. That's the one of those three that they have up there, Fool.com. But Money and CNN, I'm not a big fan. There are better indicators for stocks and other investments. Barron's. It was in a text box here, but it didn't quite show up like it should have. But Barron's is a good weekly newspaper. Now you probably want to get it on the internet. Regardless of what you think of Fox News, whether you like it or not, I can't listen to it. Well, I can't listen to any of the news channels too much. But Neil Cavuto on Fox is pretty much a straight, has big money manager kind of folks on there, and usually has a pretty good eye of what's actually going on with the markets with not much politics involved. And Wall Street Journal, the journal is kind of buried in there. But again, Wall Street Journal has some interesting articles, especially if, just a general interest in business. And then down here, Morningstar is pretty good for mutual fund ratings. So those are the ones I would go with. You can also look on the internet, but sometimes you're going to get into, again, proprietary sites or sites where they're sponsored by a particular mutual fund company, so you're not always going to get unbiased advice. So between Barron's and Wall Street Journal and Cavuto, that would give you three good options to look at, and then Morningstar for mutual fund rankings. And that was it. Okay, so we're going to get more into the specifics of investing on future chapters, but the big picture is that it's all about risk and return, and making sure that if that number one, you don't just gravitate to the safest investment and watch your funds decline, just get eaten alive by inflation, nor do you get talked into or stumble into some real speculative investment and then find yourself locked out. And the worst case in that situation is to be in a very speculative investment and have it drop and jump out at the bottom. If you're in equities and it looks like you're getting clobbered, hopefully you set up a strategy where you don't need that money for a while. You can ride it out, and things will come back as they typically do if you're in good quality stocks and you're diversified. So, all right. Good night.